Hello, traders. Hello, everyone. I think we should start now. Actually, I just ate my dinner, so that is why we, we didn't start on time. And today, I just want to spend maybe 1 hour with us. Okay, and we are done. Okay. So today's class, only want to discuss about chart pattern and candlestick pattern. Chart patterns and candlestick patterns. Then combination of um, indicator and money management. That will be on Saturday. That is, we're going to round up everything on Saturday, this coming Saturday. So that means today I will only discuss about chart patterns and candlestick pattern. Then on Saturday we're going to discuss about uh, using indicators and money management, because that same Saturday we're going to do some uh, live analysis of some of the trade we're going to take during the week using indicator. So that's why I just postponed the two topic to that day. So today I just want to discuss about chart patterns and candlestick patterns. When we talk about chart patterns, what does it mean? Chart patterns are used for forecasting in Forex, which means when you draw your chart pattern, you use that to forecast in Forex. Use that to predict, or you are using that to forecast where the market will go next after the pattern is complete. Okay, so alongside with support and resistance, or we can say a chart pattern is a shape within a price chart that helps to suggest what prices might do next based on what they have done in the past. Based on what they have done in the past. For instance, if the market is moving up and the pattern start forming, let's say a triangle pattern start forming, this indicate that the market is likely to continue higher. Okay, this pattern indicate that the market is likely to continue the same thing. A reversal pattern a reversal pattern and market break the downside, this indicate that the market is likely to reverse to the downside. So that is why once we saw the pattern, once we sight the pattern, we draw the way the pattern is, we identify it and wait for our confirmation. So that means we are forecasting what is happening in the price. So in that case, it helps us to suggest what price might do next based on what they have done in the past. To trade a chart pattern successfully, you must wait for breakouts. That is why chart pattern is good, because the only way you can trade chart pattern is after breakout. You cannot trade chart pattern before breakout. Okay, the only way to succeed in placing trade is when you trade after breakout. Okay, so let's continue. Now, the the chart pattern are grouped into three categories. The chart patterns are grouped into three categories. We have the continuation pattern, we have the reversal patterns, we have the bilateral pattern. Okay, when we talk about continuation pattern signal that an ongoing trend will continue when the price of when this type of pattern occur. It indicates that the trend is likely to continue after the pattern is complete, such as wedges, flag, okay, like rising wedge, falling wedge, bullish flag pattern, bearish flag pattern. Okay, so that is why when we are trading and you want to trade a continuation pattern, you have to identify what kind of pattern are you trading on. Most especially the best pattern for continuation is a flag pattern, because when the market is moving like this, the market should continue, but the market stop in a range, in a small consolidation, finding some strength to renew its strength to continue the movement. So we call this type of pattern a continuation pattern. We have the wedge, something like this, something like this, that continue to the upside. So those are the continuation pattern that we have, the flag pattern and the wedges. Then the second one is the reversal pattern. When we talk about reversal pattern, it signals a change in direction, which means the market is moving up and this pattern form at the top. It signals that the trend will change. Or the market is moving down and the signal occur at the bottom. It signals that the price will change to the upside. So that meaning a rising trend changes to a falling trend, or a falling trend changes to a rising trend after the pattern is complete. Example are double top, double bottom, triple top, triple bottom, head and shoulder pattern, inverse head and shoulder pattern, cup with handle, and also wedges. Don't worry, I'll show you the difference between these wedges and this. There we have this as a continuation pattern, then we also have this as a reversal pattern. So the third categories is the bilateral pattern. This one is just neutral. Let me say neutral. You know, in continuation pattern, if the market is moving up and the market gets stuck here, it will still continue higher. Or if the market is moving down and the market is ranging, it will still continue lower. But a reversal pattern, if the market is moving up and the market is consolidating, it will reverse to the downside. Or if the market is moving down, the market is consolidating, it will reverse to the upside. But this bilateral pattern is very tricky at times. You have to be careful whenever you see this kind of pattern, okay? Because it can give you a fake move most of the time. This type of pattern might decide that, okay, if the market is moving down and the market is ranging here, so we don't know if the price will break to the upside or if the price will break to the downside after the pattern is complete. Okay, so we only have that as a symmetrical triangle. Symmetrical triangle. Okay, so when a symmetrical triangle form, we don't know where the market will headed to. That is why we say it signal that the price can move either way after the chart is complete, such as symmetrical triangle. The market can move either way. It can break down, it can break up, and reverse. Even like a continuation, which the price will be moving upward and still continue. But bilateral might say moving upward, form the pattern and then reverse. Or we might be confused that is it reversal or continuation. So anything can happen with this pattern. So now let's discuss more. When we talk about continuation pattern, for example, the wedges pattern, when we talk about wedges, price move upward or downward with pivot highs and low. This is the high, this is the low, pivot highs and low, converging toward a single point known as apex. Known as the apex. Look at this pattern. The market was moving upward and then start ranging inside this area. And this type of pattern that form, once we identify the pattern, we use our trend line, connect the highs and low. Okay, so once we connect the highs and low, this is the highs, this is the low, the high, the low, the high, the low. So once we connect the highs and low, then we look at the chart pattern. What this type of pattern is telling us? It is telling us that this market is moving higher. Okay, so we draw the trend line according to the highs and we draw the lower trend line according to the low. So it indicates the price is moving higher. Now, how do we now trade this pattern? What do you do is wait for the breakout. That's why I say for a pattern to successfully complete, before you open any trade, for a pattern to successfully complete, is that you should wait for a breakout. You can't trade a pattern here. Do not think or do not ever forecast that this is how the market is going to move by opening a trade here. Wait for the breakout. Once the breakout occur and the breakout is not fake, then you can start buying right away. So your entry can be here. This is the candle that break the level. Okay, then your stop loss is next support area. Okay, next support area. Do not think that okay, the stop loss is too wide. No, I'm not using it. Follow the rule. Do not place your stop loss here, or do not place your stop loss here. Don't say because you want to make a tight stop loss. No, follow the rule, because market might decide to play a little while at this area and finally resume upward. So what you have to do is place your stop loss below this, because this area might be blocking the price to go more down if the market decided to come down. So that's why your stop loss should be below the level. So if the market decided to come down, this support level might stop the price from coming down. Okay, maybe the price to still got the support and still continue higher. So if you want to be safe, always place your stop loss below structure, and your take target should be the twice of this stop loss, or make it 1 to 1 risk reward ratio, risking 1% to get 1%. So this would be your target. This is for bullish wedges. Then this is bearish wedges. Okay, you see that the two trend line are converging toward the single point. Okay, they are converging toward each other. Okay, which means that they can be extended to this and join together. So like this is a bearish wedges. So what are you going to do is draw the highs, connect the highs and lows together, and once you've spot the pattern, wait for the breakout to occur to the downside. Okay, that means this ongoing trend will now continue to the downside. So wait for the breakout to occur. So once the breakout occur, you enter the trade here. Enter the trade here while your stop loss is still above structure, and you'll take profit here, like it's twice of this stop loss. Okay, your entry is after the breakout, because there are two types of trader who trade aggressively, and trader who trade patiently. Okay, trader trade aggressively will not wait for pullback. They already know what they are risking. They already know what the market is doing, or they know the kind of risk that is involved, because this type of move, market might still decide to go more up again. Maybe this is the trend line level, market might still decide to go more up, hit the trend line and continue lower. So if you want to be safe, make sure that your stop loss is above structure high. Okay, so this is what we call the bearish wedges. Okay, your entry is here, stop loss is here, then take profit here. Now the flag pattern. What do we mean by flag pattern? A flag pattern, a flag chart pattern is formed when the market consolidates in a narrow range after a sharp move. After a sharp move, the market consolidates in a narrow range. Okay, after a sharp move, the market consolidates in a narrow range. So when you want to trade this type of pattern, you also wait for breakout. So this is the breakout. Okay, you enter the trade here, enter the trade, then your stop loss here. So your take profit will be the next level, or make it 1 to 1 risk reward ratio, or 1.2 or 1.3 risk reward ratio. Okay, same thing here. This is a bearish flag, which means the previous trend is moving down and the market is ranging inside this channel, finally break out from the breakout below the channel and continue lower. So we tag this as a continuation pattern, which is a bearish flag pattern. This is bullish flag pattern. The ongoing trend is upward and the market is ranging inside this area. So you spike out, you see the market spike out and they again come back again, and finally buyers still resume to the upside. So let's say the market spike out from the range just like this, and you enter the trade here. Then you now place your stop loss somewhere here. You might be stopped out of the trade. So it's better you place your stop loss here below structure, okay, below the next level structure. So if you place your stop loss here, you might be stopped out of the trade. Or if you think the market is otherwise not giving the way you want, wait for a bullish candle to form. Once there's any breakout, you enter the trade here, then you place your stop loss here. Then your target should be the next level or multiple of your stop loss range. Okay, so that is how you trade the bullish pattern, the bullish flag pattern. All these patterns, they are continuation pattern. Imagine, you can see the way the market is moving down and start ranging, then we quickly identify the pattern that this is a bearish flag pattern. So once you identify, you don't do anything yet, just wait for breakout to occur. Once the breakout occur, then you can start selling right away. So that is how you trade this pattern. Okay, so now let's discuss about reversal pattern. Reversal pattern like double top or double bottom. A double top is an extreme bearish technical reversal pattern that form after an asset reaches a high price two consecutive times with a moderate decline between the two highs. It is confirmed once the asset price falls below a support level equal to the low between the two prior highs. Okay, while a double bottom pattern is a technical analysis charting pattern that describes a change in trend and a momentum reversal from a prior leading price action. Just the definition of double top, same definition, the same definition that is the opposite definition of double bottom. Okay, so when a double bottom is formed, it's what are we seeing when the bottom is formed, which means that the highs, uh, the double bottom is an extremely bearish technical reversal pattern that form after an asset reach a high price two consecutive times with a moderate decline between the two highs. The market first approached the highs reverse, approach the second time it reverse, and what the by the time the market reversed again to the upside, already created a support level here. So how do you now trade this pattern? You wait for a breakout to occur and you place your trade right away. Same thing with double bottom. Market approached the first low, reverse, and created a resistance here, and then again reverse, mitigating the previous low. So in that case, the market start moving up. So once the price break the neckline, you start trading right away. So that's what we call the bullish uh, double bottom and top. Okay, so let's see how it formed. Look at this. This is what we call double bottom. That is why I indicate it a DB. DB means double bottom. Okay, you can see it where double bottom DB. This is the first bottom. So you see that the market was moving down very strongly, a downtrend, right? The market was moving down very strongly, and then it created a support right here and reversed to the upside. And again, after reversing again to the upside by mitigating the support level, it created a resistance here. That resistance is what we call a neckline. Then mitigate the support once again by creating double bottom. So the price start rising again, and finally break the neckline. This neckline is our resistance. So we use the neckline as we use the resistance as the neckline. Once the price break the neckline, you can start buying right away. So you see that when you buy here, your stop loss is the next low. Your stop loss is the next low, and your target is here. Okay. You can target 1 to 1 risk reward ratio, or 1.5, or 1.2, or 2. Okay, so in that case, your stop loss is the next low, and your take profits, and your take profits is the next high, or multiple or double, times 2 of this, the range of your stop loss level. Okay, so that is how, that means you enter immediately after the market break the neckline. This is the neckline. Okay, after double bottom is formed, the market create a neckline, and there's a breakout of the neckline, so we start buying right away. Okay, so that is how you trade a double bottom. Now, how do we trade a double top? This is double top, right? So we have a rising, price action, price movement here, and it created a resistance here and a pullback. Again, mitigate the same resistance by creating a long weak rejection. So you see that the market is getting rejection, a strong rejection from this area. So in that case, we use that as our second top. This is the first top, second top, and this is our neckline. The neckline is the support that supported the price to push higher, to mitigate the next high, to mitigate the high. Now the market start moving down and finally break the neckline. Immediately the price break the neckline, we sell right away. Our stop loss is above next, um our stop loss is above next, swing high. Okay, okay, this is where the market created this minor resistance, so that is where we place our stop loss above it, and our entry should be immediately after neckline break. Then our target should be the twice the ranging range from each, from our entry to the stop loss level. So it may be times 2, or times 3, or times anyhow you want to do it. Okay, so you just have to be careful about the stop loss, the take profit level, because you might decide to go more and put your stop loss take profit here, but the market did not reach the take profit level and start reversing to the upside. Okay, so that is how to trade double top. So I indicate that as DT. Now, the next one I want to discuss, the next reversal pattern, is the head and shoulder pattern. Head and shoulder pattern. When we talk about head and shoulder pattern, a head and shoulder pattern is a chart formation that appears as a baseline with three peak, okay, where the outside two are close in height and the middle is the highest, just like this. Three peak, one, two, three. Okay, so this is the highest. So this is the left shoulder, this is the right shoulder, and this is the head. Okay, this is the left shoulder, right shoulder, and the head. And this is our neckline, because when the market rises to this point, by creating the left shoulder, it reversed a little while. Again, it created the head. The head is now above the left shoulder. Okay, the head now is above the left shoulder, and the market dropped drastically, created the next second right shoulder. Okay, and fine, and finally the market break the neckline. So you see that all these patterns are traded immediately after breakout. Do not trade before breakout. Trade after breakout. So you see that after breakout, your entry is here. Your stop loss, follow the stop loss rule. Okay, your stop loss, do not say because there's a wide range of, stop loss, oh, the stop loss is too wide, let me just skip this trade. No, follow the stop loss rule. So your stop loss should be the next swing high. Okay, the previous swing high. In this kind of situation, your stop loss will be the previous swing high. If you have enough, money on your balance, you can place your stop loss here. Because reason why we do that, why the reason why we don't use tight stop loss in this kind of situation here, is that most of the time, before market could move most of the time before market could move into our direction, it might decide to once again visit the breakout level, maybe still consolidating. So that means you give the market enough time, enough room to breathe. Then you leave the trade running before and just expect the market to hit your target. So your target should be maybe 1 to 1 risk reward ratio or 1 to 2 risk reward ratio, or you can use a break even. Same thing here. This is inverse head and shoulder pattern, just like the opposite of this. Okay, the opposite of this. So this is inverse, like inverted, upside down. Okay, so here we have the left shoulder, we have the head. See that the head is the lowest one. Okay, and then here we have the right shoulder. Okay, see that it's just like human head, human body. The head, the left shoulder, the right shoulder, and this is the neckline. Okay, because before the market could create the head, it created the neckline. Before it created the left shoulder, it created the neckline. So in that case, this is the neckline. What are you what you should do is that you wait for a breakout to occur. This is the breakout. Once the breakout occur, you enter a trade right away. Okay, your stop loss is the next swing low, the previous swing low. Sorry, your stop loss is the previous swing low. So place your stop loss at the previous swing low. While your target should be 1 to 1 risk reward ratio, 1 to 2 risk reward ratio, or the next support, or the next high, or the next resistance. Okay, the next resistance or the next. So that is where you should exit the trade. So in this kind of situation, maybe this is going to be 1 to 3 risk reward ratio. Okay, you risk one, then three reward. So that is how to trade head and shoulder pattern. And lastly, which I want to explain, is the cup with handle. Cup with handle. When we talk about cup with handle, a cup with handle is a technical indicator where the price movement of a security resemble a cup, followed by a downward trendy price pattern. Like this is a cup followed by a downward trendy price pattern. So what are we doing here in this kind of situation is that when you want to trade this pattern, you trade the breakout, wait for the breakout, then place your trade. The market might decide to break the upper one there, or the market might decide to break the lower one. So it means that if the market decided to break the upper one, the market is moving down this way and finally break out, you might decide to go with bias. So here we have the cup with handle. Let me show you how it look like. You can see this chart pattern. This is what we call cup with handle. Okay, the major surface is like cup, and this is the handle. The handle is somewhat like something like a bearish trend. Then immediately after the price spike out of the range, it starts moving higher. So after the market break the range, you look for a buy opportunity. You look for a buy opportunity. So which means your entry is here, your stop loss is the next low, while your target should be 1 to 1 risk reward ratio or the next high. Okay, this is how you trade cup with handle pattern. Cup with handle pattern. So that is that on reversal pattern. And when we talk about wedges, this is the wedges about this is reversal wedges. The previous wedges I show you is the wedges of continuation. Okay, that means you can say that wedges can be in form of a continuation pattern and also in form of a reversal pattern, but this one is a form of reversal pattern. See, the market is moving down very strongly and starts in a range. This is what we call uh falling wedge. Falling wedge. Okay, so price move upward or downward with a pivot high and lows converging toward a single single point known as apex. So we see that market is moving down and these two trend lines converging to each other. So immediately the market spike out of this zone of this range, we start buying immediately. So your stop loss should be in the next low, okay, the next low. So while your target should be 1 to 1 risk reward ratio, or 1 to 2, or 1 to 3. So that is how you trade wedges, rising wedges as a reversal pattern. Okay, this is rising wedges, this is falling wedges, this is rising wedges. Rising wedges when the price is moving higher, and then you saw this wedge, this price movement in a range. So try to draw a trend line connecting the highs and low. Wait for a breakout to occur. Once the breakout occur, you enter the trade here. Your stop loss is above structure, and your take profit is the next level, or 1 to 1 risk reward ratio. So you see, this is how you trade wedge pattern. This is how you trade wedge pattern, like the as a reversal pattern. The last one is the uh, bilateral chart pattern. So that one is only for symmetrical triangle. We don't have any other option. I can let me say, if I should add uh, a channel, rectangle channel, okay, that would be another class or so. Or let me just say symmetrical triangle is the most popular bilateral chart pattern that we have. We can also include channel. Okay, we can also include channel, but this is the best. This is the most common bilateral chart pattern that we have. That is the symmetrical triangle. What is symmetrical triangle? Symmetrical triangles occur when a security price is consolidating in a way that generates two converging trend lines with similar slope. Okay, similar slope. Both of them are having the same similar slope. Similar slope. So here the market is neutral. What are we waiting for is that let's wait if the price will break the upside or the price will break the downside. In this case, we don't know, we are not sure yet what is really happening in the market with this chart. We are not sure. But we are only sure if the price break out of either up or down. That is what we are waiting for. Same thing here. Once the price, this is like a bearish symmetrical, this is like a bullish symmetrical pattern. So here you see the price breakouts of this range, then we start selling right away. And here the price breakout of the range, then we start buying right away. So most of the time, if this kind of movement occur, the market might decide to break the lower side. If this kind of movement occur, the market might decide to break the upper side. So it's just neutral. What we have to do is wait for the price to break either both sides, break the either way. So maybe the upper side or the lower side. So this is how we trade symmetrical triangle. So these are the chart pattern that we have. These are the common chart pattern that we have in the market, in the forex market. The common one, the simplest one. So you might have or so you might have heard about diverse or different chart pattern, but this is the most common one. The most common chart pattern I always like to use. So So you see that this chart pattern is very more important when it comes to trading. So you have to pay attention to them. Anytime you trade, once you saw at this pattern, you should pay attention which pattern are you trading on. Is it a continuation pattern, or is it a reversal pattern? Okay. So the next topic here I still have with us here is candlestick pattern. Candlestick pattern. Candlestick pattern are form of charting analysis used by forex trader to identify potential trading opportunities. This is based on historical price data and trend. In particularly, they are commonly used for forex trading. They rely on past price action for forecast future price movements. Candlesticks are useful when trading as they show four price points: the open, the close, high, and low throughout the period of time the trader specifies. Trading is often dictated by emotion, which can be read in candlestick charts. When you open your charts, there are different kind of. Okay, let's go to the chart now. When you open the chart, there are thousands upon thousands of different candlestick formation. Thousands upon thousands of different candlestick formation. But I only have the one I usually trade with. That is what I want to share with you. We have thousands upon thousands of different candlestick, and all these candlestick also can be said to be indicator, indicator for us, because when we are trading, you can use the candlestick as your own indicator. So we have thousands of upon thousand candlestick shapes. Then, how do we make use of candlestick? That is the most important thing. When you are trading binary option, when you are trading binary option, the most important thing about binary option trading is, like, if you really want to uh, dig deep about being profitable in binary option, is one, know how to analyze candlestick, and the second is zone. The second one is zone. Know how to analyze candlestick and know how to identify zone. You see, these two methods, once you know it, forget about, just you see that candlestick candlestick psychology will be easier for you, no matter what. Okay, look at the trade that we took today in the signal group. Look at the trade we took today. The market was bad. The market was bad, actually. The low volume in the market, but we still managed to make, I think, 7 ITMs, or let's say maybe 5 or 7, because I give out some setup or some awaiting signal too. So we managed to make 7 ITM, no loss, no OTM. So, which means that in binary option, candlestick is very much important in binary option. So if you really want to dig deep on how to be successful in binary option, is you have to know how to analyze candlestick and also know how to identify zone. But here in forex, like I say, forex is complicated. You must know everything. You must know everything. In forex, candlestick pattern works in forex. But the way you expect it, once the candlestick pattern form, it only give you a signal. This signal doesn't mean the market will move right away. Immediately you spot the signal. It only move into your direction if the market is good, or if there's no too much volatility in the market. Look at this AUD USD that we took a trade. Do you know the reason why I took this trade? The reason why I took this trade was because, look at this trend line which I have drawn. I draw this trend line, draw here, so connect here, connect here, connect. Now I saw the market break the trend line. The market break the trend line, You know, after the market break the trend line, I have to look for a candlestick that's close. Like if I look for a candlestick that close, like for example, what if after the market break the trend line, I have to look for candlestick that's close and open below the trend line. Look at this. This is the candlestick that break the trend line, but it opened before the breakout. It opened here, so it happened before the breakout. But this, it opened here and closes here. So which means if they see this type of candlestick outside after the breakout, it means that the market is ready to go down. So I'm still expecting the price to go down, although my stop loss is still safe right away, but I'm expecting the price to go down. Maybe it doesn't want to go down yet. So what I'm expecting is the price should go down. And the candlestick pattern which I see, which I use here is strong red candle. Strong red candle. This is ranging market, and a breakout occur, and after that a pullback, and after this pullback, market form another green candle. This green candle indicates a buying pressure, so I buy right away. But most of the time the market might still come down, play around before it start moving up, so I buy right away. So that candle which signal to me is that strong green candle is what signal to me to buy this trade. So when you are buying or selling, do not think the market will just move up straight. No, it can't happen like that, because there's nothing like holy grail strategy in the forex market or in any trading. There's nothing like holy grail. All my strategy doesn't work 100%. All my strategy doesn't work 100%. What I mean is that not all the time the market will be good. You can apply strategy today, and you can apply your own strategy today. The market give you good results, you win all the trade, but tomorrow you try again and market start failing you. So there's no holy grail in the market. There's nothing like holy grail in the market. So same thing, if you decided to open a trade here, the market might still come down again, consolidate. If your stop loss is not safe, it might stop you out and continue upward. Or most of the time, the market will just continue moving higher. If you look at those chart patterns that I showed you, you see that the way the market reacts when they reach those level, when there's a breakout, the way the market reacts. Same thing can happen like that. So when you enter a trade, always look for chart patterns. Before you enter a trade, look for chart pattern and look for candlestick pattern. Look for chart pattern, look for candlestick pattern. So the candlestick pattern which I saw here was a strong red, and this is where we enter the trade, because I don't know, the market is still running. I will have waited for the price to stop before I enter the trade, but I took the trade here. We took the trade here. The market is still running, but it closed with a rejection, and a strong green candle formed. Before you know, it got rejection because of this zone. So the price is now below the zone. Then we see some sellers trying to enter, and finally, and suddenly we see some buyers again entered again. I think the market is will play around for some time before it find its way to the downside. So this is that on this pair. So when you are trading, always pay attention with candlestick pattern. Open for your chart. You will see that the chart is full of candlestick shapes, thousands of candlestick shapes. Okay. So, but you pick the most important one that anytime you open the chart, you should always see them. This will help you improve in trading. Okay. So same thing, look at a euro AUD. I think euro AUD, euro AUD, same thing. This is where we took the trade, but it seems the market is still, because the AUD USD is opposite of euro AUD. That is why I took the trade, buy and sell trade. So here, this is where we actually enter the trade, but see the market start dropping and come down all the way to this level, stop us out, stop us out now, still reversing to the upside. Again, it still makes some retracement. Maybe might play around for some time before it continue. So we don't know that one for sure. Let's just hope the price should go more up. So here, what did I observe? Why did I even go with buyers at all? It's because if you look at the trend line, the market was testing the trend line, nothing like that. This one, the market break the trend line, but immediately buyers entered. But immediately sellers entered, buyers again entered. This green candle you cannot say because of this green candle you decided to buy. What you have to do is wait for the green candle to open again, another green candle outside this range, outside the range. That is what happened here. After this green candle break, the next candle form red, and the next candle form green. That was my signal. So the signal I entered, the candlestick signal I entered here is this strong green, not knowing that the market will still make some kind of volatility, also kind of ranging before it start moving to our direction. Not know about that, not sure about that, but my prediction is right according to my plan, according to my strategy, according to what the market want from me. So the market want from me that okay, this candle, this green candle is not inside this zone, this range. This green candle is not inside its range. Both the opening and the closing is above the range. That indicates a new trend of will occur. So here my analysis is good. So that is why we decided to took the trade. And the trade that we took also on, I think, USD JPY. I think USD JPY. That was a money trade. USD JPY. You see the market was more ranging higher, moving higher. And this zone, I have drawn this zone on the left side. I see the price break the zone. The market makes some retracement. After the market made some retracement, what was my signal to start buying the trade? This was my signal because this candle closed here. Next candle gap down, touching the zone and form a green candle with small rejection. That indicate to me a buy pressure. A buy pressure. I took the trade because of the buy pressure. This is this is a level. Candle is approaching the level and stop randomly at this level. The next candle open and price start to push down. Once touch the zone, it rejected back and form a green candle. So that's from that zone, and the green candle not is not telling me one story, because the story is all about okay, the price reject the from the zone, which means the buyers have already entered. Some buyers have already entered. That is why they form a green candle. So in that case, it's good for buying at that moment because the buyers have already entered. And you see what happened? We start buying and markets move up to the next range, to the next level. See, the market is taking long time at this range, at this resistance level. Okay, you see, the market is taking so much time, wasting time. So what am I saying? Taking long time by testing the resistance level. First time, second time. And what are we seeing here is like creating a double top, right? This is the neckline. If you want to trade this type of pattern, you wait for the breakout and place your trade. But the market might still decided to go more up and keep moving up higher. So in that case, there's nothing you can do here at the moment. So when you want to trade, if you see a pattern, you apply your favorite chart patterns on the charts before you analyze the market, before you take any trade. Apply your favorite chart pattern, then apply. I also look for watch out for any candlestick pattern. So the candlestick pattern is just like a signal that will signal to you when you should enter the trade. So the opening, close, high and low throughout the period of time. So this is what is very much important in the forex market. The opening, sorry, in binary option, it the also is very much important in binary option, but here we are talking about forex. So open, close, highs and low also is very much important. You should know where the market opened, you should know where the market closed. So let's move on. This is candlestick basic. So where this is the bullish candle, that is the bullish candle. bull candle, buyer's candle. This is bearish candle, that is seller's candle. You know, that one is very simple. So here, when the market is having its shadow, we call it the high, and the lower shadow, we call it the low. Then a bullish candle always open at the low and closes at the high. So this is where the bullish candle open and close here, because immediately candle open, this is where it open. Maybe the sellers try to push the price down and got rejection from buyers, so the market created this lower shadow and open here already, push the price to this point, got rejection from sellers, and sellers push the price down and closes here. So open and close, same thing here. The market opened here and the sellers are pushing the price down. Let's say before the market opened, some buyers are still pushing the price up, got rejection from sellers, created this upper shadow and close open here. Then they push the price down all the way to this level, got rejection from buyers, pull back and closes here. So this is where the candle close open, and this is where the candle open. Sorry, this is where the candle open and this is where the candle close. Just the opposite of bullish candle. So this is a seller's candle. This is buyer's candle. Most people can change the color. You can change the color as the way you like. You can change any color to any color you like. Okay. So now, when we talk about bullish pattern indicate that the price is likely to rise, while bearish pattern indicate that the price is likely to fall. Candlestick pattern are categorized in two: single candlestick pattern like hammer, hanging man, inverted hammer, shooting star. Then multiple candlestick pattern like engulfing pattern, morning star, evening star. Okay, so like what I mean is that there are some candlestick pattern that stand on its own. Once you spot them, they are telling you a story about the market. There are some candlestick pattern that cannot stand on its own, but they are multiple. Like they can be two or three. Okay, like this. So they tell you a story of what the market is doing. Okay, there can be three, maximum at least three. Okay, so we have example of them like the engulfing pattern, bullish engulfing, bearish engulfing. We have the morning star, evening star pattern. We have so many of them, but this is the pattern I will explain for us tonight, the one I like use most. So now when we talk about single candlestick pattern, we talk about the hammer. What we mean by hammer is that hammer is a bullish reversal pattern that formed during a downtrend. Look at the hammer. It is named because the market is hammering out a bottom. When the price is falling, hammer signal that the bottom is near and the price will start rising again. This is support level, and this kind of hammer formed. So the long lower shadow indicate that the sellers push the price lower. The sellers push the price lower, but buyers were able to overcome the selling pressure and close near the open. They overcome the selling pressure and close near the open. This is the near the this is the near the open. This is the open and this is the close. So what happened next when this pattern form at the support level? The market starts moving higher. So this is how you trade single candlestick pattern. Okay, single candlestick pattern like hammer. The hammer must be twice or three times longer. Like the shadow should be three times longer. It can be twice, it can be three. Okay, but minimum is should be the minimum should be twice. The minimum should be twice. Okay, like longer than the body itself. So that is a good hammer, and that signal to us a trend change to the upside, so which you call a bullish trend. Then we also have the hanging man. When we talk about hanging man is a bearish reversal pattern that can also mark a top of a strong resistance level. When the price is rising, the formation of a hanging man indicates that sellers are beginning to outnumber buyers. This is the buyer's push phase, the buyer's push phase. Okay, so when the price is rising, the formation of argument indicate that sellers are beginning to outnumber buyers. Like the buyers try to push the price to this level. Next candle open here, they want to continue again, but what happened? Sellers rejected them, and all the way they are being rejected also from buyers. Buyers push the price to this point, but the candle itself is still red. That still indicates the sellers are still in control of the market. So when this kind of pattern form, it indicates a trend change to the downside, the upside, and the trend change to the downside. Okay, so this is what we call the hanging man. They are always found at the resistance. Hanging man always found at the resistance. So the wick must be twice stronger, or sorry, the wick must be twice or, or three times longer than its body. So that is a hammer candlestick. Inverted hammer. When we are talking about inverted hammer occurs when the price has been falling, suggests the possibility of a reversal. The price has been falling, then immediately we found this inverted hammer. So its long upper shadow shows that buyers try to beat the price higher. Buyers try to beat the price higher, and what happened? They push the price, seller push the price lower to this level, and again buyers entered again and they form a green candle. The candle closed near the low. Candle closed near the low. So now, because of this high, buyers have already bid the price higher here. Because of this high, so they are ready again to buy the market. They have already bid the price higher, which means we have so many bidders. We have so many bidders. We have some bidder that might bid the price here, some might bid the price here, some might bid the, maybe seller. But here the buyers have already bid the price to this level, which means they want to buy the market around here. So they have already bid. That means it's a new high, a new high has occurred. So that indicates some buying pressure. So the buyers will now start pushing the price higher. They start buying the market. Once it is accepted, they start buying the market. Most of the time, the market might still come down again, play some time, and move upward. So it depends on the market condition. There's nothing you can do about it. So the next one is the shooting star. Shooting star candle. Shooting star is a bearish reversal pattern that look identical to the inverted hammer, but occur when the price has been rising. It have occur when the price has been rising. You know, inverted hammer also occur when the price is falling, right? But this, the price is rising and the shooting star occur. Take note, the wick, the shadow, the upper shadow must be twice stronger than its body or longer than its body. Okay, so that signal to us is a trend change. So immediately this shooting star candle form, the seller starts selling the market. So its shape indicate that the price open at its low, price open at its low, rally but pull back to the bottom. Price open at its low, rally and pull back to the bottom. So in that case, this is where the candle close. Candle open here, candle close here. So it has already created a new high. That new high from here to here with a bearish body indicates a selling pressure. So selling pressure now push the price downward. So that is how you trade this pattern, shooting star candle. Now let's talk about multiple candlestick pattern. For example, the bullish engulfing pattern. A bullish engulfing pattern takes place when buyers outpace sellers by engulfing the sellers. This is reflected in the chart by a long green red body engulf a small red real body, with bull having established some control. Because when you see this type of pattern, it means that the buyers are already in control of the market. overpower the sellers. So the price could head higher. The price could head higher. We are expecting the next movement should be higher. So in that case, the buyer have already overpower sellers by engulfing its whole body. So we are not talking about engulfing the wick or shadows of the body. We are talking about the body, engulf the whole body, which indicate that buyers are now in control of the market. So same thing here, the bearish engulfing pattern. A bearish engulfing pattern develop in an uptrend when sellers outnumber buyers. This action is reflected by a long red real body engulfing a small green real body. The pattern indicates that sellers are back in control. Here, you will find out that buyers are pushing the price higher, but immediately market change and sellers now entered. The seller that entered now engulfed the real body of this green candle. That indicates that the sellers are now back in control and that the price could continue declining. So which means they are now controlling the market. So they should start pushing the price downwards. So it's just like telling a story of what is happening in the market, just like for instance, the fundamental analysis. Okay, the fundamental analysis. If the actual is better than what we have already forecast, it is good for buying. It is good for selling. Okay, maybe the market is moving down and the actual is something happened to the currency, so it might be a trend change. Same thing is just like when you're analyzing candlestick pattern. Okay, so the next one that I want to discuss is the morning star pattern. Morning star pattern. This pattern is made up of three candlesticks. Normally, a long bearish candle followed by a short bullish or bearish doji or a small body candlestick, which is then followed by a long bullish candle. Take note, this is a long bearish candle. This is a small bearish candle. This candle here can either be bullish or bearish or doji. Okay, can be bullish, bearish, or doji. Bearish, bullish, or doji. So take note, any candlestick can form here, but this must be the same thing. This can be red. This can be either green or red or doji. Then the next one should be a long green candlestick. So that indicates the buy trade, a buy option, sorry, a buy signal. So meaning that the buyers are now in control of the market. Okay, actually sellers were pushing the price down, and this now is now indecisive between buyers and sellers. Indecisive between buyers and sellers, and buyers quickly enter the market very strongly. So it indicates a buy trade, which means the buyers are now in control of the market. So we call this morning star pattern. The morning star pattern usually occur if after a downtrend. So once you see a downtrend, open your chart and see a downtrend, look for a morning star. So once the morning star occur, then you start trading right away. So this is how to analyze morning star pattern. Then the next one is the evening star pattern. The evening star pattern is the opposite of morning star pattern. Long bearish candle, bullish candle with small green candle. Small green candle, it can be small red candle, it can be a doji candle, followed by long red candle. Okay, followed by long red candle because the buyers are pushing the price higher, but this time this candle form like a indecisive, whereby the sellers and buyers cannot decide, so they will have to wait for some time. Now they wait and wait. So now they engulf the previous bullish candle, so that indicates that the price is now moving downward, that sellers are back in control. So this pattern, we call it the evening star pattern. The market is moving right higher and form this pattern, so it's now called evening star pattern. So the market will start declining to the downside. So that is how you trade evening star pattern. Okay, so this is all about candlestick pattern and chart pattern. But one thing I will let you know is that let's say for instance we draw our chart pattern. You should not be expecting the market to give you a good chart pattern, something like this. For instance, if you see this type of chart pattern and the market break the lower side, the market might still continue again, still continue inside the range. The range might take long time, might take time. Okay, the range might take days, it might take months, it might take years. So it depends on the time frame you are using. Okay, so when the pattern form after the breakout can be false. So be careful about that. Same thing, all this candlestick pattern, most of the time it can give you fake signal. It can give you fake signal. So be active. Or what I mean is that be observant and be careful. It can give you fake signal. This kind of armor can give you a fake signal. When you see this kind of armor, the market might decide to go up fine, you are correct, but the market might still decide to go more down, more down, more down, more down, more down, whereby this hammer is not working right away. So be careful, which means if you see that if you try to open your chart and the market doesn't go well, just close your chart. Okay, close your chart, come back again after you have solved everything. You have solved everything, then you can now start trading. Again, the sellers still entered. Now the market is still bullish. The market is still ranging. Same thing here. The market is still ranging. Let's just hope if the price will go more up, or if we're gonna lose this trade anyways. Let's just hope for that. So let's see. Let me start from AD card. Okay, let's do some analysis on the AUD card, the trade we're gonna take on the AUD card, and what are we expecting. Okay, look at this AUD card, the way the market is behaving. I'm looking for a support. This is a support level. From support, you can see morning star pattern. So the price really rise for a while, but it didn't go far. So we cannot expect now. Another thing I want to let you know is that if you see any of this pattern, do not keep your trade running over time or too long. Okay, do not keep the trade running too long. If you make enough profit, just that is the enough. Just close your chart because the market might decide to go up. The market might decide to go shortly and change. Okay, so it's better for you not to keep the trade running too long. Look at this pattern. You said this is money star pattern, right? But when this money star pattern form, it didn't form from the major zone for the major support, just from this trend line. So you see the market still going up, but it didn't go up far. So if you really want to be safe in trading chart pattern or trading candlestick pattern, let it be from the major zone area. Okay, let me show you AUDJPY. Just like from the resistance, we see a bearish engulfing. This is what I'm talking about. A bearish engulfing, but buyers still try to enter, maybe play around. So the market find its way to the downside afterwards. So because of this trend line, the price still keep going higher. Now look here, after breakouts, the market pull back to this support level. And from this support level, you can see a bullish engulfing pattern because this is from the major range, from the major key level. This is the major key level. This trend line is not the major, it's just indicating that the price is still upward. So this is the major key level. So from the major key level and the trend line also, we see a bullish engulfing. So we said right away the market did not come down again. The market push up straight, keep going upward. Here also, look at this. Look at this. This is resistance, right? From this resistance, what are we seeing here? Hanging man, followed by strong red. Fine. If you don't want to use single candlestick pattern and you want to use multiple candlestick pattern, you saw a red candle, a green candle, you saw this type of candle, and you saw a red. Then you decided to place trade here because of this strong red. Well, I would say if you decided to place trade here, that means you must set your stop loss here, no matter what. So that means there's no the stop loss range is too wide. The stop loss range is too wide. So you have to be careful about that. So you see the market, if you because of this pattern here and you decide to enter the trade and you place your stop loss here, your stop loss range is too wide. So eh, be careful about that. Know the type of pattern you are trading on. Know how the market is behaving near once the pattern is formed. But me, if I want to trade, although I saw this trade, honestly, I saw this trade in the morning. I wanted to give a sell signal on this trade, but I need a candlestick, one small candlestick to form before we sell. I want a candlestick, one small candlestick to form, but something now happened to AUD. The market starts dropping drastically, very strong red candle. So I said, there's no hope for me again. There's no hope for me to even sell this trade again. I was waiting that the candle should close here, but you see that it closed all the way to this level, so we can't enter the trade anymore. So I decided to forget about this trade. I've already analyzed because immediately that was the first chart I opened when I start analyzing the chart. I check AUD, USD. I check everything, but the way the markets move, most of the time, your mind will be telling you the right thing, but you still be doing the wrong thing. So when I saw this, but I wanted to open the trade, but I want the candle to close here, not here. We said, but there's a strong, and that is the reason why we lost AUD card. AUD card. Let me tell you the reason why we lost AUD card. If you are in the Telegram group, there is a there is a forecast. This forecast setup I sent in the Telegram group about AUD card. If you remember something like this, then I saw the market break the uh, level and then return back. So I decided that okay, we are selling this trade. So I forecast the market should be like this way, that we are selling this trade. So maybe something happened. I didn't remember that we are selling this trade. And that was the analysis I did last night. I sent the setup last night, expecting that maybe I'll wake up in the midnight before, but I just slept or I didn't remember. So what this morning I saw the market already move down and start moving upward. Immediately I saw the market start moving upward after checking the trend line. I saw this is a break. Wow. I say it's good for me to start buying anyway. But my mind is still telling me that look at this chart. You set up your analysis to be a downtrend. Maybe this movement is still part of mitigating this zone. This movement is still part of mitigating this zone. That was my second thought. That if the market is still mitigating this, that means the market is still in a downtrend. That means we will have the opportunity to sell the market, but I still think of buying because of the breakout. Now the market gave me a fake breakout, come down all the way, give me and stop us out of the trade. I still want to buy. The reason I want to buy is that this type of move, the market might decide to form another strong green candle. That is what I'm expecting. I'm expecting strong green candle to close above this, then we start buying or look for or wait for some time and start buying. That was it. But you see that this candle close above and open above the zone. This it open and close above the zone. That's why I think the market will keep going up, but the way the market is just tricking us, or is just confused. I'm confused. The market should go more down, but it still try to mitigate this zone. My mind is telling me that this market is mitigating this zone, but my other mind is telling me that, hey, watch out the breakout of so-called, let us buy right away. So I decided to buy. So that is why we lost this trade. So that is that on candlestick pattern. Okay, let's do some analysis. Let's see what the market is having for us. Let me just remove all the charts and remove this one also. Okay, so let's do some analysis. Maybe the market we're going to, the trade we're going to take tomorrow. Let me start from 4 hours charts. I like 4 hours charts. Okay, I'm going to use one thing I've explained today, the candlestick pattern, but I didn't see good, and I didn't find a good setup yet. Okay, okay, okay. Look at this trade here. This is 4 hours chart. The market create a support. This is a support zone. This is support zone. So from this support zone, I'm seeing rejection from buyers and a inverted hammer. Rejection from buyers and inverted hammer. So that indicates to me maybe the buyers are staying in control or now ready to push the price higher. So AD card, what I'm expecting on AD card is, if the price will, as the market is still here, as the market is still here, we are not buying immediately. Let me now go to 1 hour. Let me check on what is happening in 1 hour. 1 hour, we have some buyers movements, some buyers entries and a breakout, and here also just like a bearish flag pattern. Maybe the market should go more down. So let me draw the pattern. So this pattern, it's like a wedge pattern. That is a continuation wedge pattern, a bearish continuation wedge pattern. We saw some strong selling pressure, and see this pattern. So first time the market break the level, move down a little bit, and let's say our stop loss is still here, and pull back again, and now it's, the market is still going down. Okay, so I think we are late to start selling this market right away. We are late to start selling, but if I want to sell this trade, this is how I'm going to do it. I'm going to, once the price come back to this level and I saw sellers already enter, then I'll sell from here. My stop loss will be here. That is above structure. That is 30 pips. My take profit will now be 1 to 1 or 1 to 2 risk reward ratio. That is here. My take profit should be here. Okay, 1 to 1 or 1 to 2 risk reward ratio. This is 1 to 2 risk reward ratio. Okay, so this would be my take profit level. That means if I should sell this trade, I will still wait for the price. Let's see if the price will come back to this level. Once again, we start selling right away. Remember this zone. This zone is what it doesn't allow the price to go down immediately, because we still have some barrier. That is why we have some bullish candles here, because of this zone. So let's hope and see if the market mitigate to this level, and we said again. So our stop loss is still here. Before that, executing our trade, let's check other market conflict. Let's see what is happening on. Let's check this. Okay, still far. Let me check 30 minutes. Still far. Let me check 15 minutes. Very close. Okay. Let me check the 2 hour. Still far. Okay. This is still a downtrend. So let me check 50 moving average. Yes. Look at 50 moving average. Resistance and its price is going down. So that would also be a sell trade too. Let me check 20 moving average. Also 20 moving average. See, both the price is going down. So what I need is price to come to this level. Let's say uh 0.918852. 0.91852. That is once the price comes to this level. Do not, like I said, do not use pending order. Okay, you can use pending order, but for me, I don't want to use pending order. If you want to follow me, follow my trading style, I don't use pending order. You can, if you want to use pending order, you can use a sell limit. You can use sell limits, but I don't like using pending order. I like watching the trade once close to the level, except if I will not be available or too busy that will not allow me even to check my phone or to hold my phone before I can use pending. But there's no way I'm going. My phone is with me, my laptop is with me, my computer is with me, everything is with me. So I will be checking the market from time to time. So once the price reach the level, I will execute the trade right away. I will not execute here because most of the time, if you trade sell, the market might still come back again, play around, and continue. Even by the time the market come down or come to this level, you might be in loss already. But if you want to trade at the right time, wait for the pullback to occur and trade. But let's see if it's going to happen. If it doesn't happen, let's wait for the breakout of this zone and small pullback and start selling. So let's see. That is AUD card. Let me check AUDJPY. AUDJPY. Let me remove or let me close this. Close this. Uh, Close this. Starting from 4-inch time frame. Bullish trend, and the major trend is down. Now this is bullish trend. There's also a breakout. Also, this pattern is like after this breakout, is this from resistance? Let me check it out. Uh, okay, uh, okay, it's like more like a resistance to me. The swing high, something like this. Swing high. The market did not reach that high. Let me check again. Let me check. Let me use this first, so that let's see, so I will not be confused. Something like this. I don't want to use a wide range zone. I want to use a tiny one. So if you want to use draw a zone, let it be a tiny one because this is 4 hour chart. If you not use a wide range zone and go to 1 hour chart, it might be too wide. There's a touch. Okay, that is what I'm expecting. And from this support, the breakout occur. And here we are seeing the evening star pattern, or let's say Vasa pattern, three black row. We are seeing a three black row. So here, um, these are three black row. Let me go to 1 hour. 1 hour, we see the after breakouts, the market tests the trend line, and you see some sellers entry, just the same move like AUD USD. So we see the market is trying to go down. Okay, the market is trying to go down, but we are not safe in open trade here. Let me check 30 minutes. Let me check 15 minutes. I'm still seeing some kind of ranging or consolidation here. Okay, some kind of consolidation. Once the price break this trend line, we sell. So once the price break the trend line, we sell. Then our stop loss will be above this level. Let me check 50 moving average. Let me check 50, 20. Let me check SMA. SMA is not even close. That means SMA is asking us to use this as take profits. Fine. Let's use that take profits. And our stop loss should be above this structure. Should in case the market try to go up above structure. So I think our risk reward is 1.19 risk reward ratio. So which means after the breakout, we sell right away. Even this 50 moving average is telling us that wow, the market is still down. Maybe by trying to get rejection here, the market is still down. The 20 moving average also showing the price is still down. Though these two moving average, 20 and 50, they are not the strongest one. But this SMA is the strongest one. So that is why I decided to say let us take profit here. Because market might reach this level and didn't continue lower. So here, let's see what is going to happen. I think I should leave the trade here. So once there's breakout of this trend line, let me draw it well so that I will not be confused. So once there's breakout of this trend line, we can start selling right away. But now I'm not selling. I'm not taking the advantage that the price is above this entry point. That okay, let us sell. Maybe we make good profit. No, I'm not taking the advantages of that. So what I want is a breakout, a strong red candle. After that breakout has occurred, then we keep the trade running. So I'll be okay with that. But I'm not okay by selling right now. It's not okay for me to sell. Because the market, the reason if I sell, because the market might still continue again like this. Okay, it might take time before it break. So I'm only waiting for the breakout to occur. Once the breakout occur, then we start selling. I think this will be our trade tomorrow. Tonight, or let's just keep an eye on it. Once there's a breakout, we sell. So that is two trade now that we are waiting for entries. Two trade now, AUD card and AUD JPY. Market is really bad this today. Market is really bad. See, consolidation. Even the trade that we took is still consolidating. See, consolidation, no strong momentum. Consolidation. But I hope the price should go up if I take profit. This take profit is not enough. It's not that much. So just more take profit. That means if this market it take profit, or sorry, it this zone, something is going to happen also on AUD USD. So AUD USD will not be a long trade anymore. We not, let's say for instance, the market hit this zone and AUD USD only move a little pip. So the pip might not be the same, but still the market will still make move according to our plan. So which means the, let's say our take profit is now here. First take profit is here on AUD USD because of Euro AUD, the The zone is not that the take profit level is not long. It's not too much. Something here. Okay. Okay, guys. This is our analysis for today. So I use the topic that we treated today, the chart pattern and the candlestick pattern. This I use chart pattern, but the market is already start moving. Though we should have entered the trade here, but the market has already start moving because this is rising wedge pattern as a continuation. So after that, after the breakout, the market has already moved down. All again, the market visit the trend line and some sellers entered. Let's say we now enter the trade here and decided to sell again. But this time the market is very bad. So if you really want to set this trade, we wait for a pullback to occur to this entry point. Once the pullback occur, then we sell right away. Or we wait for a breakout of this zone. Once the breakout occur, we sell or you wait for retracement, then we sell. So we have two ways, two areas of selling. Do not take the advantages of selling here because the market might decide if you sell this now, the market might decide to go more up, range before it starts. This is night. This is night time. The spread might be too high, so it's better for you to be careful about it. So open trade. Um, don't open trade without observing. Okay, guys. So, like I said, on Saturday we're going to discuss about using indicator to analyze the chart and predict the market, and also money management. Money management. These are the two topics we're going to discuss on Saturday. Money manage. Also, we're going to do our weekly forex analysis. Okay, so that is all. Okay, guys. With the absence of question and everything, your suggestion, everything. If you don't have anything to say, I think we should call it today and meet again on Saturday. Good night, everyone. Have a nice night. Have a nice sleep. Bye bye.